In this section, we're going to talk about credit. When lenders look at basic approvals, they're going to look at three main sections. They're going to look at credit, they're going to look at income, and they're going to look at assets. So this section, we're going to talk about credit. So we're going to talk about the bureaus that are involved, some of the scores and where some of those rankings kind of come into. We're going to talk about the types of credit, and then we're going to talk about some derogatory items or things or blemishes that could be on your credit. All right, so the credit bureaus, we have three of them. We have Equifax, TransUnion, and Experian. Now, what a lender does, a mortgage lender does, is they're going to pull what they call a tri-merge credit report. That means it's going to have all three of the bureaus that we pull from. Now, we do not take an average of those three. We actually take those three scores. We're going to take out the highest and take out the lowest and use the middle score. It does not combine them and take an average. It's not an average of those scores. It's what they call the median score. We take out the highest, take out the lowest, and that is the score that we'll use for judging interest rates, mortgage insurance, and other parameters for those loan qualifications. Now, the scores, these are kind of a ranking that I have kind of put down. This is kind of where a level is. Now, a minimum credit score for getting into a mortgage right now is about a 580 on an FHA loan if you're going to buy a primary residency. If you're looking at second homes and investment properties, you're probably looking at 660 to 700 as more of a median score that you would probably want to see to get an approval on those types of homes. But 580 to 620 is kind of like getting a C on your report card. A 620 to 660 is kind of like a B minus. 660 to 700 is like a B. 700 to 740 is like an A, and anything 740 or higher is about an A plus. Really, after we get about 760, we've kind of hit the top tiers for pricing and what the investors are happy about when it kind of comes down to your credit profile. Now on Equifax, TransUnion, and Experian, you could Google all three of these, go visit their websites. You could ask them to send you a copy of what they have once a year. It may or may not have scores on it, and mortgage scores will score differently than maybe autos or credit cards. You know, we have different scoring models that we use, but what you want to look at here is what trade lines are getting reported to my credit bureau on these three levels. Not every creditor goes to all three. So by going to all three, that's a free way to kind of see who is saying things about you on your credit report. Now, Equifax has a boost system. If you go to Equifax.com, look at their boost system, there might be a way that you can kind of use one of their systems to automatically give you a little juice on your credit score. So that might be something good to check out. Now, I'm going to kind of go through the types and the derogatories, and I'll try to reflect on how it may impact your credit scores here as well. So when we look at different types of credit, we have revolving, installment, and other. So revolving is like your credit card. So I have a credit card, let's say it's got a $10,000 limit on it. I charge up about a $5,000 balance on it. I start paying that $5,000 back. I can still use the credit card in the meantime. I'm paying on it, I'm using it, I'm paying on it, I'm using on it. It is a revolving type of trade line. Now, a good rule of thumb for credit cards is try to keep your balances to about 25 to 30% of your limits. That's just a nice sweet spot. Once you start going 50, 60, 70, 80% of your limit for your balance to your limit, it's going to start impacting these scores. Once we start using a lot of our credit debt and not paying it back, it may start taking you down. So that's something that's one area you can kind of concentrate on. Installment debts. Now, a great example of an installment debt is your auto loan. So, hey, I go and I borrow $25,000 to purchase a car. I've got a payment that's set on anywhere from a 3-year to 7-year term. As I make those payments and that debt is now gone, that installment debt is then paid off. We get a lot of people who say, hey, I paid off my car loan early. That should be a benefit to my score. Actually, it may be a derogatory, because that's a trade line that's active that is showing payment history. It doesn't know in the models right now that you paid it off early. It just knows that you had a payment and a balance, and are you paying it on time, which I'll kind of get into here in a minute. But you want to talk to your lender or credit repair expert before you think that paying that off may impact you for the better or for the worse. Now, there's some other types of trade lines that I want to kind of emphasize here. We have mortgage trade lines, student loans, and what we call as an authorized user. A mortgage trade line kind of acts like an installment debt because I've borrowed X amount of dollars to purchase a home and I'm making installments on it. But from a credit score standpoint, this is going to have a little bit more impact just because of the size of the loan, and the credit bureaus just look at it a little bit differently. Having great pay history on a previous mortgage or your current mortgage is a great lifter to these types of credit benefits. Student loans. Get a lot of questions on student loans these days. Hey, my student loans are deferred. I'm not making any payment. I don't have any debt there. Well, the investors don't look at it that way. You're looking at traditionally mostly 30-year fixed loans. Even if you went to 20-year or 15-year terms, the investor knows eventually a payment is coming, and that they're going to use some type of qualifying number for that payment. And that is usually estimated at about 0.5% to 1% of the balance for a monthly estimated payment. Now, if you contact your student loan company and can come up with a smaller payment arrangement on that, it's possible we could use that, but you want to talk to your lender before making that type of agreement to see how it would impact your scores or what we consider as your debt to income ratio. Authorized user. Let's say you don't have a lot of credit. I'm younger. I just never used a lot of credit. Maybe my parents or a family member would let me go on as an authorized user for one of their revolving or credit cards. That's a great way to boost your credit scores because you get to kind of tail on to their credit history. If they've been on that credit card a long time, had a good payment history, they're keeping their balances low, that could be a benefit. Now, you want to talk to your lender or credit repair person before doing that, but it might be another idea to consider. Derogatory items. So we have late payments. There's some types of small derogatories and what we call as major derogatories. So late payments, we have 30, 60, and 90 days. This is how it is reported to the credit bureau. So let's just kind of take an installment debt for a minute. Let's say that my payment's due on the 1st, but I don't make it until the 28th of that month. So technically, I'm 27 days late. There may be a late penalty fee-wise from my investor that, hey, I didn't pay on the 1st, so I have to pay a little bit of a late penalty. But until it goes 30 days late, it is not recorded as a late payment on my credit report where it would impact my scores. Now, if you go 60 days late or 90 days late, the longer I go without making a payment, the bigger impact it'll have on those scores. Now, collections are usually smaller items. Somebody says I didn't pay them, they're going to send me to collections. They have just reported to the bureaus that they're going to collect on you, or they're trying to collect on you. Judgments are a little bit more formal. They've kind of gone through some more formal paperwork, maybe with an attorney or with the courts. You do not want to go and just automatically start paying these and assume it's going to improve your credit. These may have some time frames on them that are older, and by paying them, they could actually hurt your score. You want to talk to your lender, you want to talk to your credit repair person before making an idea of just going and randomly paying those, because you could end up actually possibly hurting yourself than improving that. Medical is something that we're seeing quite often now. People go to their doctor's office, they have medical insurance. The insurance doesn't pay the whole doctor's visit, so nobody tells you that there was a balance due, and the medical collection company will just put it on your credit report. There's some things happening now that this might start subsiding, but if you see this, these are great little ways to maybe go in and negotiate to take these off, have them removed, and get some immediate impact here. Again, you want to talk to your lender about that before going through. Now, these are what they consider bankruptcy and foreclosure are considered major derogatory. So I've had something, a life event that's kind of happened to me where I've gone through bankruptcy or I've gone through foreclosure. Bankruptcy is going to come into two different formats. It's going to have a Chapter 7 or a Chapter 13 in most instances. A Chapter 7 means I wrote off the debt, I went to the courts, I wrote off all the debt, and I just walked away. A Chapter 13 says I went back to the creditors and I stopped them from collecting any more interest. I went to the courts, and now I'm on a payment plan so I could repay them. So there's two different kind of flavors that kind of happen there. On a Chapter 7, most likely you're looking at anywhere from 2 to 4 years before you're going to be able to go back into a mortgage scenario. It might be as low as 1 year if you're on a Chapter 13 and you have good pay history. We would have to get the courts to sign off on that, but if you have some bankruptcy questions, let us know. Foreclosure, that means I had a mortgage, I stopped payments on that mortgage, and the bank came and took my home away to repay the mortgage debt because they foreclosed on my home. Now, that doesn't mean that you can never get a mortgage again, but these are going to have the longest time frames. On FHA, you're probably 4 years out from the discharge date on your foreclosure, and it's up to 7 years on conventional.